Good evening, and thank you for your time. My name is Joshua Tam, and together with Andy Lam, Caroline Gao, Gabriella Liu, and Oscar Shi, we are Team SPI. We're excited to present our proposal to Canadian University and how SCD Asset Management can contribute to the endowment's goal in achieving net zero. We'll begin the presentation going through the firm's investment policy and investment process. Then we will outline our recommendation and risk management considerations. Finally, we'll conclude with our investment plan timeline. To introduce our firm, we'd like to walk through our investment philosophy, which can summarize by five main points. The first is our client-centric investment objectives. Ultimately, our clients' needs are paramount, not only to our success, but our clients. And understanding their needs and expectations is at the core of our firm. Governance is our second focus. When looking at companies, we believe that those that act responsibly as corporate stewards will generate superior returns in the long run. Next, we're focused on long-term investing, not market timing, which means long-term fundamentals and due diligence is essential. Fourth, risk is incredibly important to us. Deploying the finite risk that our clients entrust to us require us to ensure we maximize risk-adjusted returns. Lastly, development of a sound investment thesis and decision-making is essential to our success. So how does our investment process look like? Here at SCD Asset Management, our approach is simple. Integrate our net zero considerations into every step of our investment process. What do we mean by that, and what does it look like in practice? To meet our strategic targets for our customers, we focus on four main pillars: active engagement, sector targets, divestment targets, and financing transitions. It boils down to this. At every step, whether it's our investment strategy creation or investment selection, even monitoring, whether our decisions are in line with those strategy pillars is important in every step. Next, Gabriella will take us through our portfolio management process.
Our investment process involves in the fund selection, asset allocation, review and monitoring, and the due diligence. We conduct our research from the certified ESG rating site to select the high performance with the net zero target companies or investments and add it to our portfolio. We review the asset allocation every quarter and every year to ensure those asset companies are still complementing the net zero theme to their daily operation. Our portfolio aligned with IIGC net zero investment framework and will adjust with this framework updates accordingly in the future. Next, Caroline will give you some details investment of the recommendation.
Thank you, Gabriella. Based on the information available, including the 2032 net zero target, we recommend our SCD net zero portfolio to Canadian University. The objective of our portfolio is to preserve capital and maximize risk-adjusted returns, while also addressing financial implications of net zero target. Based on the data from Sustainalytics carbon risk research, our portfolio has lower than category average carbon risk score and fossil fuel involvement percentage. This means that our portfolio has less exposure to risks in the transition to low carbon economy and promote direct and indirect carbon emission. Our portfolio adopts a long-term investment strategy by observing 10-year tracking record of the underlying assets and benchmarks. We make long-term investments in funds that creates value through sustainable impact investment approach. Our balanced portfolio are well diversified in various sectors and geographically, with asset mix in equities, fixed income, and alternative asset classes around the globe. Our portfolio has a 118 upside capture ratio and 80% downside capture ratio, and can provide capital protection and generate investment growth at the same time. Our performance record indicates that we achieved the return target of 4.5% over CPI for 80% of the time. Next slide, please. Our objective is to achieve a total transition to net zero target by 2032 through investing in our portfolio. We measure our performance in this regards by evaluating how much exposure we have to companies that are allocating significant capital towards direct and indirect carbon emission. We conduct our research on ratio of green capital over revenue on our portfolio to make sure it aligns with our net zero target by 2032. We also measure our portfolio utilizing the carbon risk score and fossil fuel involvement score available from our data source partners like Morningstar and Sustainalytics. Our investment selection process allows us to only include the funds that meet our green capital over revenue and the green score targets. Next, I will pass it on to Oscar to give us the introduction on the asset allocation of the portfolio.
Thank you, Caroline. Based on our investment philosophy and target, we developed a balanced investment strategy with 5% in cash and equivalent, 20% in Canadian equities, 20% in global equities, 40% in fixed income, and 15% in alternative investment. We have the reasonable range to adjust our portfolio construction by up or down 5% per each asset class. This strategy will ensure we stick to our target and philosophy, which preserves the capital and maximize the portfolio returns through capital enhancement and investment income. At the same time, reach the total transition to the net zero target by 2032. We used our due diligence process with search through different portfolio managers and funds mandates, and finally, we landed 4 funds in our portfolios. There are 2 equity-focused funds with the main target to generate capital growth and another fixed income fund to maintain the investment income while reserving the capital. We are using the alternative funds to diversify our portfolio in order to reduce the unsystematic risk and hedge against the inflation rate. Our portfolio contains investment worldwide, mainly focused in North America, at the same time across all different sectors. Now let's dig into the funds in detail. First, let's look at those 2 equity funds. They share the same investment philosophy with us to maintain the low level of carbon risk score and reach the net zero target in the next 10 years. Those 2 funds with top 10 holdings in our portfolio, mainly focused on banking and financial institutions, with around 10% in total. Next, let's dig into the fixed income funds. Most of the income investment is invested in corporate bonds and debentures, with more than 64% above the investment grade. We also take maturity into our consideration. For the BMO Sustainable Bond Fund, we have the most maturity from 3 to 10 years, with more than 65% in total, which align with our total transition to the net zero target in 2032. And last, we'll see our alternative investment fund. It is a global sustainable real estate fund that mainly invests in different REITs. The most focused sectors are specialized REITs, industrial REITs, residential REITs, and retail REITs. They invest in different companies with green buildings, green leasing, and emissions reduction. Next, I will pass to Caroline to talk about portfolio and performance.
Thank you, Oscar. As a long-term responsible active investor, we care about the environment as well as how much value we can add to the portfolio over time. By using the time-weighted average method, we have demonstrated our portfolio performance over the past 10 years. We can observe that except for year 2016 and 2018, we have overachieved our performance target each year. I would also like to direct your attention to this graph. This shows that for every $100 invested on January 1st, 2012, which is 10 years ago, our portfolio have a better cumulative return than the return target as of December 31st, 2021. Now I will pass it on to Gabriela to introduce our risk management process.
Oh, thank you, Caroline. The risk for portfolio is composed by 2 types of main risk, market risk and ESG climate risk. Under the market risk, there are several risks we need to focus on. Interest rate, liquidity risk, and credit risk. In the high inflation environment, it drives up the interest rate up and the bond yield up as well. But the bond price turns out to be lower. It also discounts the purchasing power of the payment we would receive from the fixed income securities. Our diversified portfolio with multiple asset classes provides the first layer of the protection, but we need to continuously monitor the market interest and adjust the fixed income weight mixed with different maturity and geographic bonds to mitigate the interest rate impact. Some risk concentrate among the different individual issuer across a variety of categories. We estimate the sensitivity of the portfolio to the potential risk factor and then run the stress period historical data, such as the 2020 market correction to COVID-19 and 2008 financial crisis. We integrate this analytics to simulation analysis to assess the possible portfolio impact and the sensitivity to the market situation. And the other main risk category is the ESG and climate risk. This risk could impact differently on each asset class in the portfolio. For example, for equity, the company's value and growth may be negatively impacted by the implementing the net zero target, such as reduce water usage, switch to the green material in order to reduce the greenhouse gas emission. The degree of impact will be various by geography, asset allocation, and product mix. Climate risk on the fixed income asset rely on the reputation and nature of the issuer, but it only affected the long-term holdings. Net zero exposure is difficult to assess, especially for equity and corporate bonds. Climate impact can be highly company specific. We will use climate scenario analysis to include both transition and physical risk scenario on portfolio, which has forward-looking view on impacts of climate change and can help inform investment strategy, portfolio construction, and the asset allocation. By employing the risk management strategies, we believe it can help smooth the overall performance and improving the risk-adjusted return. Next, I will pass it to Andy for the investment timeline.
Thank you, Gabriela. So to achieve a sustainable, peaceful, and resilient portfolio, in 2022, we will start preparing and adopting a responsible investing policy strategy, which includes the carbon exposure reduction and climate risk within our ESG framework. This means we'll be pursuing a green-focused ESG-related investment opportunity for our endowment. To set up a strong base, we will be applying to investment manager selection, monitoring, and termination activities, joining a collective with priority focus on climate change to enhance engagement, preparing disclosure, and monitoring measurement and development. By 2025, we want to reach 30% reduction. And by 2028, 65% reduction. And we can start looking to see if we want to start adopting low carbon in-depth passive investment as we are in the later half of the time horizon. Lastly, we want to achieve a net neutral carbon footprint by 2032. Since it's a 10-year aggressive plan, we will be having yearly reassessment of the fund against a benchmark discussed previously and act appropriately to make sure we reach our goal by investment and carbon footprint by 2032. We will solicit climate risk assessment and scenario analysis from active manager in this space and prepare update reporting with standard metric scoreboard. And as for due diligence, first, we're going to have to forge a shared vision. So we have to create a purpose and a comprehensive roadmap to a strong base. Then we're going to do a full analysis and reassessment when the time comes. Commit to the action plan, support the implementation, and do ongoing monitoring whenever, every year. Thank you for listening to our presentation and have a great day.